Hi, this is Sonya Wong with QX Financial. Let me tell you a little bit about what we do and how we help our clients. The first thing we do is we help our clients identify whatever goals and objectives they may have, whether it's buying a home, saving for retirement, or education. We believe that the role of a financial advisor should really be to work with you and for you so that you can take the necessary steps to accomplish your goals. And we want to make sure that whatever goals you have, they become a reality in the most efficient manner. It's very important that it's not just about saving a finite or fixed amount of money. For us, the mission is really about helping our clients build wealth. What do we mean by build wealth? For us, a person who possesses wealth is somebody who's actually able to live off of his or her assets at some point. If you have wealth, it means that you would not have to work anymore, yet you're still able to sustain the lifestyle that you want. That may or may not be your goal right now, but that's our definition of wealth. The way that the financial industry has gone about helping people build wealth and achieving their financial objectives is by focusing mainly on two areas. The first one is saving, and the second one is investing. And these two areas are incredibly important and they should definitely be part of our financial lives. But the financial industry focuses so heavily on these two areas that they overlook a third power that is potentially even more profitable and more helpful for clients to build wealth. And that is the power of banking. To help us understand the power of banking, one of the most important concepts that we share with our clients is a concept called opportunity costs. So, what do we mean by opportunity costs? Most of us tend to think of money as a one-way street. We either hold our money or we transfer it to somebody else when we spend it or purchase something. In other words, most of us think that money can only do one thing at a time, but in reality, money has the potential to do multiple things at the same time. What happens is when the focus is only on saving and investing, is that we think that money can do only one thing at a time. And as a result, we're not taking advantage of all the properties and functions that our money could have otherwise performed. What many people don't realize is that once they've spent their money, they've also lost control of that money. So let's say, for example, that we buy a cup of coffee that costs $5. In principle, we're not only giving up the use of the $5 in exchange for that cup of coffee, but we're losing any future interest or equity that we could have earned on those $5 forever. So banking is not a product, but rather a financial position. It's a strategy of understanding and utilizing money as a multiplier, meaning that money can do different things simultaneously. This means that we're able to utilize our money, but yet retain the ability to continue to earn equity on that money. We define this as the power of banking because that's exactly what conventional banks do. Ideally, you would want to keep that power for yourself in order to build your wealth. Just to help you understand how important this is, let's take a look at the average American. Let's say the average American today is earning $70,000 per year and is going to work for 30 years. So if we were to multiply $70,000 by 30 years, that means that this person is going to earn $2.1 million in his or her lifetime. So this person should theoretically be a millionaire, right? Well, sadly, what happens with most people is as they earn all their money, they have very little to show for it in the end, because as quickly as the money flows in, it almost as quickly flows back out because they're generally transferring their money away. And that's why this idea of wealth transfers is very important for us to point out and focus on. Because transfer our money, we're also losing control of our money. So let's take a moment to think about all the money that you've earned in the past, and then think about all the money that you'll ever earn in the future. Let's assume, for example, that all that money fits within this circle, which we'll call the circle of wealth. There's generally a limit as to how much money each of us can earn. And in economics, this phenomenon is covered in the principle of scarcity, meaning that not all of us can have everything at the same time. The decision that we really need to make here is how much of our money we're going to keep. The average American is going to spend anywhere between 30 to 35% of every single dollar they'll ever earn paying taxes. If you're a W-2 employee, you'll need to pay FICA taxes, which means 15.3% comes out of every paycheck up to a certain level. Then you've also got to pay federal income tax. And then after that, state income tax, and then other types of taxes that the state will impose on you. As you can see, the average person is spending a large chunk of every dollar they earn towards taxes. And then next, the average person is going to spend another 25 to 30% of every single dollar they earn towards debt service. This can include anything like a mortgage, a credit card, and other types of loans that people typically take on. So what's left for us to spend? It's this slice here, the lifestyle money, which covers our needs and our wants. So needs would include something like our utility bills, our cell phone bills, and just anything that we need to live our lives, basically. And then the wants would be things like gifts for family and friends, vacations, maybe weddings. So if you have a particular goal in mind, like saving for a home, saving to buy a home, or saving to fund a child's education, what the typical financial advice you're going to get is set aside 15 to 20% of your gross income. Based on all these factors, there's less and less money available for your own lifestyle because most of our money is being transferred to somebody else. And then on top of that, the financial industry focuses primarily on returns. Because interest rates have been at a historic low in the past decade, investors are increasingly pressured to reduce the amount of money they can spend on their lifestyle so that they can invest that money to generate a big enough return over the next 25 to 30 years to replace all the wealth transfers in this circle. Sadly, this is the reason why most people cannot retire successfully, and it's the reason why most people can never accumulate wealth in the way that they want to and actually leave a legacy to their loved ones. This just goes to show that the conventional or mainstream approach is flawed and inadequate. But what if I could show you a way to be more efficient in achieving your financial goals? What if I could show you a way to reduce wealth transfer to taxes by 10%? And what if I could show you a way to reduce wealth transfers to debt service by another 10%? Wouldn't you say that I just made you 20% on your money? You see, there's more money in not losing money than in making money. If we could find a way to prevent you from transferring this money away and putting this money back to work for your benefit, then that would be the best possible outcome. And then something else to keep in mind is that the main slice of this pie here, the wealth transfers to taxes and debt service, also represents opportunity costs because we're never going to see any equity or return on that money ever again. So in coming full circle, how much equity do you think this person who was earning over $2 million, how much do you think he or she got to keep? Probably close to zero. And that's really true for most people. And that's the challenge that most people in America are facing. So the solution to the problem is really to pay close attention to how we define things. In the United States, we use a system called capitalism, with the key word here being capital. The solution to the problem is to teach our clients how to actually accumulate, protect, and keep as much of their capital as possible. And that's exactly why we need to talk about banking, because banking, again, is not a product. It's a financial position, and it's a multiplier effect that's designed to give us the ability to have our money do different things at the same time. Let me show you how this works. In the United States, we use a banking system called the fractional banking system. We've been using it for a long time. In fact, most of the world also uses this system. Just to show you a very simplified example of how the fractional banking system works, when you go to the bank and you deposit $1, that dollar gets multiplied anywhere from 9 to 12 times in many different ways. After the bank receives this money, that money can go into something like a mortgage, a credit card, and other types of loans that the bank can create. Then what the bank's going to do is charge interest to all the borrowers for the use of your money. And the rate of return is going to be anywhere from 24 to 32%. And then for the privilege of using your money, the bank will turn around and pay you a whopping 0.4%. So who are we all working for here? Well, based on the current financial model, it feels like we're all working for the bank. Do you see why saving money in this usual manner cannot really help us accomplish our goals or build wealth? And the same argument goes with investing. Investing can potentially provide you with a higher rate of return, but there's also the risk that the investment will lose value. And another major problem is that the money is not liquid. And why isn't that money liquid? Because if I want my asset to continue to grow and compound, I cannot get rid of the investment because it needs to be locked in to generate returns for a future purpose. This would prevent me from using it for another potentially better way to generate interest or equity at the same time. This is another example of opportunity costs. So when we're referring to the power of banking for the average person, what we mean by that is that you can deposit money into an account where this dollar can be used for your benefit as the account holder so that you can use that money for other purposes and investments. All the returns from that asset would actually go back to you where you have liquidity, use, and control of that money at the same time. Here's an important question for you. When a bank receives a deposit from a customer, is that deposit an asset or a liability to the bank? The answer is that it's a liability to the bank. If you as a depositor withdrew that money from the bank is obligated to give you your money back. Here's another equally important question for you. When the bank makes a loan, is that loan an asset or a liability? The answer is that the loan is an asset to the bank because it's generating income for the bank. Now, what if we could flip that script and make you the bank? The most ideal solution is to set up your own system, your own legal structure where you have liquidity, use, and control of your money. You can retain the ability to use your money and the ability to control your capital and liquidity, and do so in such a way that you can still compound your money. What happens with most people is that they don't realize everything they do is finance, literally everything. And whenever I mention this, people are often puzzled and they say, well, I don't finance anything. I pay for everything in cash. Well, it may be a little shocking to most people, but under the current conventional system of money, the saver and the debtor are actually two sides of the same coin. So if you're a saver and you want to buy something, you generally accumulate a certain amount of money to buy that item. So let's say you have a savings account and there's something you need to buy. So what you're going to do is you're going to build up your savings until you have enough to buy that item. Then when you have enough, you're going to withdraw it from your account, theoretically bringing the account to zero. And then if there's something else you need to buy, you're going to start the process again by saving enough money until you have enough to buy that item, and then repeat the same process for other future purchases. If you're the debtor, you're doing the exact same thing, but in the opposite direction, meaning you're going to have to borrow the money first, and then you're going to have to pay that loan balance down to zero. Then if there's something else you need to buy and you're in the same financial position, you'll need to take out another loan, and you'll need to pay that loan balance down until it's zero, and then keep doing it for other future purchases. So how much equity do you think the debtor and the saver are each going to have in the end? Unfortunately, they're each going to have zero because neither of them had actually compounded their money. The better way is for both of these people to have the ability to save, invest, and spend their money, but in such a way that it creates a compounding effect. Just to give you an example of that, let's compare two ways to buy a car. Let's say that we have $50,000 in our savings account and we need to buy a car that costs $30,000. We'll withdraw $30,000 out of our savings account, leaving us with $20,000. So then the next time the account earns interest, let's say the interest rate is 5% a year, that's going to be 5% of the $20,000 because $20,000 is what's left in the account. But then the problem here is opportunity costs. We're losing the 5% in interest that we could have earned on the $30,000 that we used to buy the car. And this just isn't a very efficient way to grow our money. So what I'm proposing to you here is that we help you set up your own bank where you have the $50,000, but you can still buy the car that you need anyway. But the next time the account earns interest, the interest that's going to be credited is going to be based on your $50,000 as if you never took the money out. Now, this is banking done the right way because you're compounding all of your money in the most efficient manner. And obviously, 5% of 50,000 is better than 5% of 20,000. And then naturally, if you're an honest banker and you actually put your money back into your bank, your own bank, with interest compounding to your account, then what's going to happen is that you're going to have more money in your bank. So my point to you is that by recapturing all the dollars that you would have used for purchases and expenditures anyway, and by deciding to implement a banking system for your own personal or business finances, you'll be able to retain and control your capital. And most importantly, you'll be able to build true wealth and a successful future. This is how we'll be able to address the problem of opportunity costs. And you can accomplish this in a tax advantage environment. So what I mean by a tax advantaged environment is that at a minimum, the money will grow tax deferred, and at best, the money would grow tax free. So as long as a client properly takes a distribution according to Internal Revenue Code guidelines and not as a withdrawal, there wouldn't be any taxable capital gains. As a result, the client would not receive a 1099 after each tax year. Also, there wouldn't be any federal or state income taxes on proper distributions. And then the client would be able to do all this without taking any more liabilities. This can help the client save anywhere from 10 to 40% on their money so that they can continue to build their wealth even faster and more money in their pockets to spend, invest, and better yet, the money will continue to compound more efficiently. If you have any questions about examples where we've been able to help clients implement a banking system, please contact us. Thank you very much.